Is the US economy heading for a painful recession or at the beginning of an explosive recovery? The answer will decide which assets perform and which get left behind. In this video, we're going to answer all of those questions so you know where we are in the business cycle and how to capitalize on it. So the basic problem is that the US economy is sending mixed signals. Some indicators say reacceleration while others point to a slowdown.
The weakness in the labor market, as you know, once it begins to weaken, it's very hard to reverse that momentum.
I think this is pretty much the sweet spot macro environment for this backdrop we're in today.
Don't look to the Fed to bail out the economy.
As an investor, you're reading, watching different types of commentary, and you're stuck with the question of which story to believe.
As the markets recovered from April, the big, beautiful bill has passed. The likelihood of the Fed to start cutting rates again has come to pass.
If you cut rates here, you're going to cut the interest income of retirees. You're going to tell people there are more rate cuts coming, so why borrow now? Let's wait and see. The whole history of the 21st century is rate cuts don't stimulate growth.
Economies move in cycles, and we want to know, are we early, mid, or late cycle? Early cycle economies favor interest rate sensitive companies like small caps or high beta growth names.
We've seen for the first time in 3 years, small cap, mid cap, and large cap earnings estimates getting revised pretty strongly.
And actually, I think that's why small caps have been the second best performing group after Mag 7.
These companies often rely on cheap borrowing costs, and lower borrowing costs fuel speculation and markets reward potential over fundamentals. Now, mid-cycle economies favor strong fundamentals, so companies with steady growth and strong balance sheets. This is also the longest cycle, so leadership is constantly rotating. Late cycle economies favor companies with defensive attributes. They're either defending against inflation or an economic slowdown. For example, energy and materials are the inflation, so they become an inflation hedge. Consumer staples and utilities usually have consistent demand regardless of economic strength, and they also pay dividends, which becomes a great hedge for a slowdown. Now, if we go to the post-pandemic cycle, we can see history prove this out. The second half of 2020 was pure early cycle economy. We saw meme stocks, crypto, and unprofitable small caps absolutely explode. Now, somewhere between February and March of 2021, the economy started to turn mid-cycle. Mega cap tech companies dominated pretty much all the way through the end of the year. And by January of 2022, it was clear the economy was entering late cycle. From about November 2021 through October 2022, we saw both defensive and inflation hedge assets perform. Now the critical question, where are we today? With the Fed officially beginning its rate cutting cycle, confidence across industries can now re-accelerate. Lower rates will spark a credit expansion, fueling housing, hiring, and consumer spending. With the labor market weakening, the Fed is expected to cut multiple times going into 2026, and that puts us at the beginning stages of a credit cycle.
The 30-year mortgage could drop 150 basis points. That's a lot of easing for the housing market.
Technically, the financing cycle is still in its early stages, and that brings us to the manufacturing cycle. The ISM Manufacturing Index is a broad survey of corporate confidence across the largest companies in the United States. Above 50 is expansion, below 50 is contraction. And if we cut it into thirds, we can observe all three cycles throughout history. Right now, the ISM's been below 50 for its longest stretch in history. Translation, business expansion hasn't even begun. And this points to an early cycle recovery.
So I think business confidence recovers if the Fed starts to cut. And so the combination of easing mortgage rates, business confidence recovery, I think is kind of a broadening cycle. And actually, I think that's why small caps have been the second best performing group after Mag 7.
Now, the Fed's going to cut rates in September, and we should see the ISM rise above 50 in the months ahead as credit expands throughout these industries. So in my opinion, the US economy is in the second half of an early cycle. Interest rate sensitive sectors, industries, and assets should outperform. In the description below, you're going to find a list of individual assets that I'm using to position myself for an early cycle economy. If you enjoyed the video, don't forget to smash that like button, subscribe so you don't miss the next update, and let me know in the comments what your thoughts are. I'll see you in the next video.
The short end of the curve coming down helps everything from smaller businesses that are still paying interest rates in the high 8% range. It helps reduce the prime rate, which goes often into credit card APRs, auto financing, and HELOCs. So it provides lower rates directly to businesses, both public and private. And that backdrop also could help to bring down the long end of the curve, which of course could help the housing sector as well.